Good morning, everyone. Feel free to keep taking food and schmooze a bit, but try to be a little bit quiet. We're going to start right now with the program. My name is Shimon Shkuri. I'm with Ariel Property Advisors. And what we're going to do this morning, we're going to first welcome everybody. Thank you for coming today. The weather today is much better. You know, we booked good weather, which is good. We're very happy that we have about 250 people registered to this event. And as you know, we asked people to pay money. That money goes directly to a cause to legal outreach. And we're very pleased and happy to say that we raised north of $10,000 today. And our company will match that with another $10,000. So we're going to have about $20,000 raised for the organization. And about Legal Outreach, which is an organization we're supporting for many years now, you can hear directly from James O'Neill, who's the head and the founder and an unbelievable man that I got to know a few years back. And I'd like you to please come and speak for a few minutes.
Good morning, everyone. Good morning. Can you hear me?
Yes.
Great. First, I'd like to thank all of you for coming today and purchasing tickets to this event. As you know, the proceeds are being donated to Legal Outreach to support the expansion of our program, which I'll describe in just a couple of moments. And of course, I'd especially like to thank Shimon for his generosity in designating Legal Outreach as his nonprofit of choice. Shimon has given significantly to Legal Outreach for many, many years, both personally and through Ariel Property Advisors. Now, for those of you who aren't familiar with Legal Outreach, you're probably thinking, oh, this must be a legal services organization. But actually, we're not. We are more of an educational organization that simply uses the law as a tool for inspiring young people in underserved communities to strive for higher education in all types of professional careers. Our students come from Harlem, East Harlem, Bed-Stuy, Brownsville, Jamaica, Queens, the South Bronx, Crown Heights, East Flatbush, and probably at least a dozen other underserved communities throughout New York City. Yet through the implementation of 11 educational and academic skill development programs, which we implement over the 4 years of high school, our students coming from these poor communities end up matriculating to some of our nation's most recognized and competitive colleges. The median income of our students and their families is somewhere in the mid-30s. And most are actually, in fact, the first in their families to matriculate to college, and certainly graduate. Yet with the boost that we're providing to them, and the hard work and sacrifice that they're willing to make, literally they're putting in 2,300 hours during their high school years over and above high school, there's little doubt that these students will become members of the middle class that is quickly vanishing within our nation. I'm going to speculate here for a moment, but I believe that one of the reasons that Shimon has invested in us and continues to support us is that he doesn't really think of us as a charity. Instead, I think he really looks at us as a nonprofit investment opportunity. And of course, as with any investment, you're looking for dividends. You want it to pay off. And in this particular case, the payoff that Shimon is seeing year after year after year is college acceptances, college enrollment, college persistence, and college graduation. We encourage all of you to pick up literature on your way out about the organization. If you'd like to make an additional donation, that's not to say that we don't appreciate what you've already done, but if you'd like to make an additional donation, you can do so by check or credit card. But we also are interested in those of you who are investing in particular communities, underserved communities that are on the rise. We think it would be a great opportunity for there to be some synergy where you're investing in real estate in those communities, but you're also perhaps supporting a couple of students from those communities as well. We'd love to get together with you, meet with you to talk about the opportunities that are available and how you personally or your company can become more involved. And again, Simone, thank you so much for your magnanimous support. Over the years, you've helped propel legal outreach to unprecedented heights of success and accomplishment. Thank you.
Housekeeping. There are more seats here in the front. If anybody wants to sit and not stand, you can stand, but if you want to sit, there are seats in the front. Feel free to come in and sit here. And we'll start our program this morning. I'm going to give a very short presentation, about 10-15 minutes, of the investment sales market. The presentation is a snapshot of the 6 reports that are on your table this morning. More importantly, this morning we have 4 panelists that are sitting here with us. And right after the presentation, we're going to hear from them about the investment sales market and the development market. All of these speakers are very active in the market and can enlighten us with a lot of their wisdom, hopefully. To my right, Kevin Davis of Taconic Investment Partners. Right by him, Justin Palmer of Synapse Capital Advisors, David Dishy of L&M Development Partners, and Joe Colriggs of the Hudson Companies. Thank you very much for being here today. So, in terms of our presentation, we're going to start with looking back about 6 months ago. I stood here or somewhere else, I think it was here, and discussed what's going to happen in the second half of 2013. We'll spend a minute on that, then we're going to talk about all of the statistics, what happened in 2013 in terms of sales volume and in terms of pricing, all product types, all boroughs, and we'll discuss the 2014 projections, what we see for the year to come. For those of you who don't know much about us, and I hope that's not too many here, Ariel Property Advisors is an investment sales firm. We've organized our company around 2 disciplines, the investment sales division, the brokers, and the investment research division, the ones who produce the reports and look at the asset evaluations and put them together on a regular basis. Last year we sold about $600 million worth of transactions, and our analysts analyzed about $4.5 billion of real estate and 700 properties. So let's start with the past 6 months. When we looked at the second half of 2013, about June or July of last year, we thought that there will be positive drivers in terms of sound fundamentals. We looked at the condominium market, specifically below 96th Street. We saw a tight inventory, the lowest inventory that's been there for 14 years. However, we also expected rents to continue to rise. And in some markets, they actually stabilized, specifically below 96th Street. So while they kept going up in the outer boroughs, we've seen some stabilization in the rental market, in the residential rental market below 96th. We also did not expect interest rates to change. And if you remember, there was a little bit of a hiccup in the middle of the year, although the Fed did not taper with anything last year. So we felt that the environment was very, very sensitive, and just a little bit of a talk about tapering moved the market. That changed by the end of the year, but we didn't expect that to happen. But overall, we did expect a very positive ending for 2013, and that's what we got. We thought we had more positive drivers than potential headwinds, and therefore we've seen a lot more transactions in a very big year in terms of pricing as well. So let's look at 2013 in terms of volume of transactions. Throughout the city, all 5 boroughs, we've seen $37 billion of transactions, a 23% increase year over year compared to 2012. both the number of properties and the volume of transactions went up as well. 2013 had a huge second half. Now let's look at the borough by borough breakdown. So Manhattan below 96 is the first one with $27 billion or 24% volume increase year over year. But as you can see, the transaction volume and the property volume have gone down, which means larger transactions and more institutional investments. So what was the real story of Manhattan below 96 in 2013? First was the strong fundamentals. The job market has done well. Unemployment went down from about 8.8 to 7.5%. Rental prices, while they were up in the other boroughs, they stabilized, as I said before, at the end of last year. But the condominium market has gone up drastically. It's gone up 12%. The real story of the condo market is not the average deal that went up 12%, but it's about the luxury market that's averaging today $2,300 per square foot. Also, the new development market that's in terms of asking price is between $3,000 to $5,000 a foot. That condo market drove development and will drive development, we believe, in 2014. Development land value or land volume went up almost 80% year over year in terms of trades. The price per buildable square foot for land went up 13% to $456 per buildable square foot. But again, that's not the only story. The story is also about locations that could fetch close to $800 per buildable square foot because of higher and luxury condos in that market. Last but not least, institutional transactions. So if you look at the market below 96 and you look at 100 million and up transactions, 70% of all transactions in Manhattan below 96 were at $100 million and higher, or $18.3 billion. That's compared to $11.9 billion in 2012, and it's a 54% increase. We believe this will increase as well. We believe this trend will continue in 2014. Just to say one word, this is still about 60% of what it used to be in 2007. So we have still some growth potential towards that peak year. Brooklyn. The year ended in Brooklyn with about $4 billion of transactions, which is slightly lower than 2012. It's important to mention in 2012, there was one major transaction, $751 million of Kings Plaza shopping mall that skewed the numbers a bit. And if you look at the transaction volume and number of properties that were sold, that was up significantly, about 30%. So Brooklyn is definitely experienced a very transactional year. We believe that will continue. So what's the story with Brooklyn? The story with Brooklyn is really in emerging neighborhoods. That was the 2013 story, in our opinion. Approved zonings in Bushwick and Crown Heights. Bushwick, Crown Heights, Bed-Stuy had many of the transactions in Brooklyn, accounting for about 25% of the transactions. Bushwick and Bed-Stuy also saw prices of land double during 2013. And the Gowanus, spurred by the new Whole Foods on 3rd and 3rd, volume of transactions went up or doubled to $130 million compared to 64 last year. We anticipate that emerging neighborhoods will continue to do very well in 2014. But meanwhile, prime markets are building on their game. So we see the Barclays Center, it's as most of us know, it's the highest grossing venue in the US for concerts and shows. But we also see large-scale international investment in the form of Forest City, Ratner, and Greenland, the JV of the Atlantic Yards. So we believe Brooklyn will continue to flourish in 2014, both in terms of volume and transactions. Queens. Queens is usually not a transactional borough, but this year we've experienced about $2.8 billion of transaction in Queens, about 46% increase year over year. The number of transactions and the volume have gone up as well. Definitely a blockbuster year for Queens. If you look at the chart in front of you, you can see that in terms of the number of properties trading, in 2013, there were more properties trading compared to 2012 and 11 together. So we really had a great year there. The story in Queens is the institutional multifamily sales. 11 transactions above $20 million took place in 2013. Just to give you a comparison, between 2010 to 2012, these 3 years, there were only 6 multifamily transactions with value of 20 and higher, 20 million and higher, that traded. So definitely a big year in the multifamily arena. Also, the strengthening of the northwestern Queens areas. Most of the transactions and the activity, about 70% of the transactions and activity are happening in Astoria, Long Island City, Elmhurst, Corona, Woodside, and Sunnyside. So that's another interesting point to mention. And development in Queens has been trading well, mostly in Astoria and Long Island City due to transportation, proximity to Manhattan, and proximity to Roosevelt Island because of quarantine. Northern Manhattan, year over year, $2.12 billion of transactions. Northern Manhattan experienced the highest dollar volume increase year over year in 2013. In terms of property, more properties traded, significantly more properties traded in 2014, and in 2013, I'm sorry. And the story of Northern Manhattan in 2013 was portfolio sales of multifamily, strong fundamentals, and strong land sales. So in terms of the multifamily market, we've seen cap rates drop to average 5%. For those of you who look at transactions today to buy, you know that it's closer to 4 by now. The averages per foot and per unit have gone above 2007 levels. And in terms of the condominium market, below 125th Street, we've seen dollar per foot at 1,000, which is a number that we haven't seen before. In terms of residential rental, we've seen some buildings breaking $50 a foot below 155th Street. So we're definitely bullish on this in this area and believe it will do very well next year. Bronx, the Bronx, $1.7 billion of transactions for 2013, 13% increase year over year, more transactions, 27%, or more properties trading. The story with the Bronx in 2013 was the retail resurgence. We've seen a 190% increase year over year in the volume or dollar volume of commercial sites trading. Major retailers and REITs are we're buying retail in the Bronx, focused on transportation hubs, and also attract public investments. Public and private investment partnerships definitely defined 2013. Kingsbridge Armory and La Central, just 2 examples. The Bronx is going to transact well in 2014. We're going to see a lot more transactions in our belief. This is a borough that hasn't experienced the growth of the others until now, and we foresee that. Cap rate compression is something that we'll see in the Bronx in 2014 as well. Cap rates went down a bit this year. We'll expect them to go down further, which means higher prices in the Bronx. It's one of the areas you can still get yield, at least on the multifamily asset class. So 2014, where are we headed? We'll try to predict. There are several potential headwinds. Interest rate environment. Is the Fed going to, taper more than they said they will? Are they going to change interest rate other ways? What's going to happen with the new administration here in the city? The new mayor, there's some uncertainty about that. And the rental market, as I said several times, rents in Manhattan below 96 have stabilized. Did not affect the boroughs. The boroughs are doing very well. Is that going to affect the boroughs and vacancy rates? Another question mark. In terms of advantages that we see in the market, the first and foremost is a supply-demand equation. In 2000 and between 2012 to 2010 to 2012, there were 147,000 new residents in the city. That's almost the same as the 10 years before that. So a lot more residents coming to the city, very little construction, comparatively speaking. We know about 15,000 new residential units coming on the market. That's compared to about 29,000 that came on the market in 2007. Increased in international capital. New York City is still a major safe haven for world investments. And also strong fundamentals. As I said, the job market, I mean, unemployment rate, we spoke about that a little bit. Unemployment today is 7.5%. Remember, in 2007, it was closer to 4%. So we see a definite, fundamental upside in the employment here, in the economy, in the local economy. And a few other things that positively affect the city are the tech industry, and the student housing, and in general, the universities that are expanding, NYU, Columbia, and Cornell. So in conclusion, after all these questions, in terms of volume of transactions, we believe that 2014 will be much higher in terms of volume. We'll see more trades, we'll see higher than, we think, $40 billion of transactions. Absent a major event that we don't foresee, this is going to be a big year in terms of trade. In terms of pricing, we believe prices will go up. We don't think it'll go up at the same rate it did in 2013. And it also is somewhat of an event-driven year. We should watch for interest rates, we should watch for the local and global economy, local and national economy, and the new mayor. These three will affect, in our opinion, 2015 more than 2014. So we're expecting a big year. But that concludes the presentation. And now to the interesting part of the event. Let's talk to...
Then you get one at breakfast, or sit down and talk and say, done.
The panelists that I have here, I mentioned by name each and every one of you. What we'd like to do now is if you can give us a few words about your companies, and then we'll jump into some questions. So, Kevin, would you like to start?
Hi, Kevin Davis with Taconic Investment Partners. We are a New York City-based and focused owner, operator, and developer of real estate, office, retail, and residential. We don't invest or develop or get involved with hotels, and because it's New York, very little industrial. Since our founding in 1997, we've acquired and or developed about 12 million square feet of commercial space and about 3,000 apartments. Over the next year and a half, we'll probably add another 2,000 apartments and probably about another 2 million square feet of office. So we're very active now. Generally, we're value-add and opportunistic players, so we're looking for opportunities where we can reposition and or develop and really create yield. We're not a core buyer. Again, we're 100% focused on New York City.
Justin.
Hi, so basically everything that Kevin just said is the same for Synapse Capital, minus office plus hotels. So my name is Justin Palmer. I'm a partner at Synapse Capital. We are an owner, operator, developer in the city. We acquired 5 properties last year, and that was our first year in business as principal investors and developers. We have 3 multifamily projects and 1 mixed-use hotel, retail, and residential.
David Dishy with L&M Development Partners. We are a firm that in the city for about 30 years. We're focused on New York City, although we've got some work in New Orleans and San Francisco, and we're expanding in New Jersey. Our focus is generally in the mixed income space, so these are projects around both market and affordable homes. We are both ground-up developers as well as investors in existing properties. We also have a fund platform that invests with other operating partners in kind of affordable preservation space, generally in New York City. That money comes from the city community capital side, and Goldman Sachs or the investment group. We are very active. We sort of tend to focus out of the Manhattan core, both rentals and condos, and getting sort of mixed income with partnering with existing landowners, buying existing sites, trying to sort of figure out, similar to Kevin. Kevin's actually a partner of ours on, we are partners on Seward Park. And we're looking for stuff. We're a little bit nervous about all the rising prices that Shimon keeps talking about. But, looking forward to a good 2014.
Hi, Joe Cole-Riggs with Hudson Companies Incorporated. Hudson is a residential developer. It was founded in '86, and since then it's built about 5,000 apartments. We work along all ranges of the spectrum of housing, from affordable subsidized housing to market rate luxury. And we also focus outside the Manhattan core on value. Recently we were designated as a fund manager for the New York City Controller's Office to invest pension money in developing unsubsidized affordable housing, workforce housing. And we're focused on purchasing affordable land to build value-oriented housing in Brooklyn, Queens, all boroughs of Manhattan, New York.
Thank you. So I have a question about the development market or the residential development market and developing rentals versus condos. We looked at a presentation, we saw the prices of land in Manhattan below 96 went up a lot. We know they went up a lot in different locations, like in Brooklyn as well, in Queens. And up to a few years ago, one could assume, he or she can develop rentals and make sense of it. Is that still the case? And what are you developing? Is it rental? Is it condos? How do you see the market in 2014 for people?
Well, we happen to be developing a condominium building right now, and this summer we're going to break ground on a 400-unit rental on 52nd Street between 10th and 11th. It's very hard to buy land today that pencils out economically for rentals. Given what's happened in the condominium market, you referenced the average condo selling for $2,300 a square foot below 96th Street. That's driven up land values remarkably. So everything that we see that's zoned currently for residential, land, you have to project. I mean, basically in Manhattan, you see land trading at $600, $700, $800, $900 per FAR, which is just amazing. You have to project $2,500 to $3,500 a foot to sell out. Now that just doesn't pencil for rentals, even if you're getting $90 a square foot, which premium buildings like Mima, the corner, they're 90, 100, maybe 110 at the very best. It still doesn't pencil out. So, given where land values are, it's very hard to make rental work. Now, you can make rental work with subsidies, and our partnership with L&M and BFC partners to redevelop the Seward Park Urban Renewal Area. We're going to be developing 500 affordable units, but that's because that was priced into the equation in our evaluation with the city. So unless there's either a subsidy or you're able to somehow suppress the land value, which is what we did on 52nd Street. We bought into 52nd Street when it was M zone, so it was not zoned for residential, and we've taken it through a rezoning process to allow for residential. So we're able to do that because we effectively subsidize our basis by taking the rezoning risk. Otherwise, it's extremely difficult to build rentals today.
Yeah, no, I think that's the case across the city. We often find ourselves in the rental deals that we have, they're often partnerships with existing landowners who sort of just want to stay in and are willing to sort of endure a longer, be more patient in order to have, what everyone dreams of having, which is lots of rental apartments to pass on to your kids and grandkids, right? And that's everyone in this room's dream, I imagine, certainly mine. And so that's the one thing that drives us. So the economics may still not make sense, but there's a willingness to sort of joint venture and hold out. Certainly, that's a tougher patience to have in a Manhattan market that, as Kevin describes, with the land. Ironically enough, the land value is actually, I would say, shocking as it is for all of us to look at $600, $800 square foot land values. It actually makes perfect sense in the context of these condo sales. And strangely enough, there's actually a drag on land value increases sometimes because we're all like, we're talking about $500 a foot. It's sort of a shocking number, but actually a pretty reasonable number in the context of that condo. So that is what it is, and so we're looking, I think your issue on the relative rents between Manhattan and boroughs is just, let's say, the quantification of the trend that we've all been talking about for a while, which is that new renter coming to New York City, looking at the boroughs not as an affordability play, but just as a lifestyle desirability play, right? You know, if you're telling your friends living in the Upper Side versus Williamsburg, you know, you gotta sort of get a discount to say you live in the Lower East Side, right? And so that, it's a natural trend that as those Manhattan pressures go, those rent folks are saying, listen, I'd rather live in Long Island City, I'd rather live in Williamsburg. So that'll continue.
Yeah, the one thing I would add is that, you know, you really have to break it down by neighborhood and location of the city. And kind of to David's point, we're value oriented. So we've been looking in Upper Manhattan. We have something in Williamsburg that we timed very well. And land market moved in our favor while we were in contract. And we're doing a project in Jersey City. So the rental, you know, we're trying to stick to fundamentals in terms of land basis in the context of our overall development budget, right? Staying under that sort of like 20% threshold in terms of land cost. So I think there are plenty of opportunities to find rental development sites, but not below 96th Street.
Like David said, people are trading up. I just traded up from the Upper West Side to Williamsburg.
Just for the beard, but it
was a package deal. And rentals, we're making it work. I think anybody can make it work. The elements that you need to achieve are luck, most of all. You know, we've been fortunate to experience growth in rents, not to measure it with, but alongside at least the increase in land prices. But mostly, you know, a willingness to recognize the new world where things are going. You know, neighborhoods that weren't appropriate for market rate rentals a couple of years ago are now, and if you can recognize that, you can find land that makes sense.
And you know, while we're trading up to Williamsburg, Justin, would you like to tell us a little bit about your new project? It's mixed use. It's not just residential. It's not just it's hotel. It's retail. Can you tell us a little bit about it? Because it's interesting.
So we assembled 2 parcels off the Lorimer stop, which is the second stop in Brooklyn from Manhattan. You know, the site, it has very flexible zoning. You can build residential or commercial, and I think anybody, most people looking at that site when we were looking at it would have thought multifamily because it pencils, right? And it absolutely does at our land basis. We decided to spend a large amount of time trying to figure out the commercial component and what would be the highest and best use for the site. And we've been out talking to a couple national and international hotel operators to partner with them and build a 105-key hotel with a small residential component and then a retail commercial plinth. Our site's on Meeker Avenue, which is heavily trafficked, and we're also right next to the BQE, so that does a couple things for the site specifically. One is the entire building is a billboard. So for a hotel operator with a brand that's trying to get into New York and wants to be sort of young and cool and in an emerging market, this is a perfect opportunity for them to get exposure to the city because, you know, a ton of people take the BQE to and from the airport, to and from other parts of the city, you know, going into Queens from downtown Brooklyn. So I think where we saw an opportunity was in Williamsburg, there's a couple of very cool hotels, but they have no distribution. So we're really focused on finding the right operator that has real distribution, that have corporate demand, and that cater to these younger companies that want to be in Williamsburg, like Kickstarter, right? There's a couple of spec office buildings that Amazon has signed on for some space. So, you know, with that size of a hotel, we think there's a huge opportunity to capture some of that demand in the neighborhood.
Thank you. Let's shift for a second to affordable housing. What changes in the affordable housing policy do you see with the new administration? How do you actually make the numbers work when you develop affordable housing, if you develop affordable housing? And what additional incentives you want to see from the city when you do that?
I'll start. Obviously, Mayor de Blasio is a major focus on affordable housing. I think, as he reminds people, and I think everyone reminds themselves, which is the Bloomberg administration was incredibly focused on affordable housing as well, and sort of 165,000 unit target, and they had, you know, incredibly talented people, and they were working really hard for the last 12 years. So while, you know, change is coming, I wouldn't call it sea change, right? Because you're basically in some respects, continue what have been pretty strong, excellent policies. That being said, there's been a lot of talk both on the resources side as well as the zoning side. And I think for all buyers right now in the market, I mean, there's a wariness in terms of just an unknown landscape as far as greater inclusionary, greater affordability as a requirement, different restrictions or requirements connected to 421A tax abatements. And so as folks are looking at sites, particularly entitlement-based plays, the prospect that you're going to come out of entitlement and rezoning with similar affordability requirements as you might have thought you were going to get 5 years ago is unrealistic. And so, I don't think landowners necessarily recognize that reality, but over the next 6 months, I think you'll start to sort of see that emerge. I think the trade-off there, and there's a lot of talk now, is really the goal is trading off density for affordability. So the goal would be produce more units, but also allow for greater density. That is a complicated conundrum. I would say that the quality and thoughtfulness of the folks that the mayor is putting into place is outstanding, and so everyone gets that. They've been living in this market, and so there will be change, and there will be greater affordability required for new developments. Where, how, what form that takes, how it manifests itself in the 421A side, we'll wait to see. But I think it's an opportunity. I think a lot of the markets we're talking about, the kind of workforce-oriented rental markets, are going to be unleashed, and even greater development, and there'll be affordability as a part of them, but there'll also just be more, we were talking about before, which is sort of unsubsidized workforce housing, and that would be a goal, I think, because realistically, the capital resources are more scarce now than they have been, and like it or not, affordable housing often essentially means capital, subsidized housing.
Yeah, affordable housing obviously means a lot of different things. I'll speak to one component, which is the straightforward, subsidized, low-income, affordable rentals, typically a land project, LIHTC, HDC bonds. And what we're seeing right now is land prices across the city, even in submarkets like the Bronx or central Brooklyn, running away from how those programs were designed. So, the city has got its own land, and it's got a limited capital budget to allocate for these programs. And land prices that might have been $15, $20, or $30 5 years ago, landowners expect to see $30 or $50 or $60. And well, first of all, it doesn't pencil with the city's underwriting, and it all comes down to the city's underwriting. And second of all, even when we can find reasonably priced private land, you have to weigh the risk of purchasing land and then relying on the city to allocate limited capital to it against competing for RFPs and incorporating affordable housing into mixed-use projects. So, at least from the affordable low-income rental, either the administration will have to allocate more capital or come up with more creative programs, or look at land use. Zoning, density is probably the city's deepest reserve of affordable housing. They have, in certain markets, basically an infinite amount of imaginary money floating above the roofs of buildings if they were willing to tap into it. So if the new administration is serious about the goals that they've announced, either they're going to have to allocate a lot of capital, which is hard to do, or in my opinion, tap into unused, unallocated air rights, which is politically hard to do.
Just one thing, by the way, you're sort of in the middle of this, Jamon. The part of the trend recently, as folks know, is preservation as part of an affordable housing strategy. So not just ground up, which is sort of what people think often, but the issue of at-risk existing properties being recapitalized and restructured, and regulatory agreements and other stuff sort of put in place to ensure long-term affordability. It's generally less costly on a per-unit basis, so sort of a bang for the buck strategy. And so I think that will continue even in possibly in a more expansive way.
And can be used with tax incentives at the end of the day, with the, applying tax credits to the buildings, which was brilliant. The city did that a few years ago and helped a lot. In terms of neighborhoods, so we want to pick your brain on the under the radar, the less valued, or the neighborhoods that are still undervalued in your opinion. So, for example, I mean, we do a lot of business in Harlem and in West Harlem, and in our opinion, you know, that area is still undervalued. I mean, Columbia University, the expansion there between 126th to 135th is going to create a tremendous demand for housing, a tremendous demand for retail. And, you know, while prices went up there, we still think there's a lot of room to grow. Are there any other neighborhoods or any neighborhoods that you view as underrated or underdeveloped that are still a great opportunity either in Manhattan or in the boroughs?
I'll jump and go first, mostly because so we've been in West Harlem for about a year now, and that one of our investment platforms is specifically focused on Hamilton Heights and the surrounding areas. So I mean, we totally agree with that viewpoint, and I think that there's much more opportunity for capital appreciation up there. We're seeing very strong rental rates in existing walk-up buildings. We're doing new development where, you know, pro formas are approaching $45, $50 a foot for new construction, and you have the Broadway retail corridor plus the subway with direct access to Columbia and to New York Presbyterian, and we think it's very attractive. In terms of other neighborhoods, I mean, a lot of neighborhoods in Brooklyn have seen significant increases in pricing and you know, meaningful drops in yield on existing properties. So there, you know, there's a few neighborhoods that we like that we've been looking at, you know, Sunset Park and Greenwood Heights that are a little further south. And then, you know, we have a project in Jersey City that's right next to the PATH station in Journal Square. And I think, you know, we bought the land for about $17 per FAR foot. We got an easement release that dropped our basis to about $12 per FAR foot, and it's tough not to make development work when land is $12 a foot.
I would say, I mean, you know, I think if you look at what's happened in New York City over the last, you know, 15, 20 years, and that's, by the way, I think been a direct result of fantastic management by two great mayors coming off of Giuliani and Bloomberg. And the city's gotten much safer, more people want to live here, and people are also willing to go outside of Manhattan. You know, it used to be basically you had Manhattan, you had Brooklyn Heights, and then sort of nothing else. I think the main driver is I view
Something make it different.
I mean, yes, so in general, but New York's becoming a little bit like London in the sense that it's a big city with lots of little neighborhoods where people kind of stay within their neighborhoods. They're not so magnetically drawn to have to be in Manhattan. And that's creating a lot of opportunity. Quite frankly, I think there are many neighborhoods that will be great over the next 10 years. I think all of them have great transportation. I think that's necessary. They have great subway access. I think one of the things, like I think Washington Heights is a great example of a neighborhood that's got great transportation, great potential. Although I don't think Washington Heights is going to transform as quickly as other neighborhoods like potentially Bushwick. And the reason for that is you've got a lot of rent-stabilized housing that just, it's hard to actually get land that you can develop and reposition. If you look at a neighborhood like Williamsburg exploded overnight. I mean, almost literally. It changed so dramatically over 5 years, and the reason for that was because it was basically an industrial area. And it's very easy to go in and bulldoze a warehouse and put up new apartment buildings and really create a neighborhood. It's harder to do that in neighborhoods that have already been built out with residential, you know, walk-ups and elevator buildings that are occupied predominantly by rent-stabilized tenants. So, you know, sort of the prevalence of developable land, I think, is a major driver, but and you know, that coupled with subway access. So, you know, certainly uptown Harlem, we like Harlem quite a bit. We like the 125th Street corridor. I think it's going to be fantastic over the next 10 years. And you know, many neighborhoods in Brooklyn, downtown Brooklyn. You know, to say that that's the next thing happening is like very passé. Everybody's kind of been there and realized that, but it's going to continue to get better and better and better. You know, we're seeing a lot of interest in, you know, even further out in Bushwick along the L line. All of that has a lot of potential. There's a lot of M-zoned areas that are going to sort of inhibit growth. Crown Heights we hear a lot about lately. Franklin Avenue is getting pretty interesting. That's an area that 10 years ago was extremely different. So I don't know. I think there's a lot of potential. And as the demand to live in the city by people continues to increase, I think those areas will fill out.
I think we are, we've talked a little bit about this, I sort of think there's a couple of east-west corridors that are really important, and we've talked a little bit about them. I think kind of the Newark, Jersey City, Lower Manhattan, downtown Brooklyn kind of corridor is an incredibly strong sub-market in some respects. And I think as world trade emerges and construction scaffolding comes down, and people sort of realize how incredible that is. With that, and then you've got downtown Brooklyn. We're actually fairly bullish on Newark right now. We're bringing Whole Foods into downtown Newark. We're doing a large redevelopment down there. We're doing some Jersey City stuff. At that access, you know, you're sort of Condé Nast workers looking for places. Where do I want to live? Actually, when Condé Nast moved down there, half of that, a large part of that decision was, you know, the analysis of their workforce and, you know, the vast preponderance that lived in Brooklyn, and not even downtown Brooklyn. So that corridor is incredibly strong. I think the sort of 7 east-west corridor, which is going to be sort of Hudson Yards all the way out through Long Island City, and then sort of a lot of really strong Queens markets beyond, incredibly strong. And then the L corridor, so you sort of think in terms of east-west corridors, successive stops along, you know, L7, and obviously downtown lacks is continuous, but if you jump from the path to whatever subway you want to get on, you can achieve that. Is you know, a useful way to think about things.
I think it's simple. You look at any given subway line, you go out as far on that subway line as you're willing to go, and then you go do more stuff.
That's it.
Then you add 20% to your purchase price, and then you might
Subway lines and being on the edge of historic districts.
That's great. Let's try one more question, and then let's open it up here to questions from the audience. Well, actually 2. First question is about financing and about you know, both debt and equity. Just quickly, what do you see in these markets? Do you see any change in the past 2 years, both from the lender's perspective, from investors who want to put money into deals? And if you see changes, what are these changes?
I'd say capital is more readily available today than it was 2 years ago, by far. The demand for investors to put capital into New York City is as high as, you know, certainly I've ever seen it. I've been in this for enough time to realize that it's outrageous right now. From a lender standpoint, you know, if you kind of rewind 5 years ago, lenders were pretty conservative. Lenders are still pretty conservative, but they're less conservative. But capital, if you have an investment that makes sense and pencils out, you'll have no problem finding the capital.
Yeah, I mean, we have a relatively young platform, and our capital partners have made all the difference in what we've been able to do. So, you know, we came out of the gate 14 months ago having never done ground-up construction as principals, and you know, we have a very fortunate situation with a great capital partner that's entrepreneurial and understands the development process. So on the equity side, you know, we've seen a ton of demand, even as a new shop. And I totally agree with your statement on the debt side. You know, lenders are still conservative, but equity is coming in to fill that gap, at least in New York City.
Yeah, same thing. I mean, obviously everyone's experience over the last 10 years makes it a little bit more focused on sort of the competence and quality of the operating partner from the lending and the equity side. But other than that, clearly, you know, things are loosening up and people are more willing to think about, obviously, for sale product, but just a broader range. But you know, you still need to be responsible and thoughtful and have a compelling sort of business strategy. It's not just I'm going to buy it; it's going to become, you know, more valuable 3 years from now.
2014. What do you think is going to happen with regards to pricing? We'll see higher pricing, lower pricing, better market, worse market, same market. Where are you on that? Just quickly.
Okay, I'll start. Nobody copied my ideas. You know, to be honest, as
We're all living in Shimon's universe. Prices are going to continue to go up.
As I look into 2014, I'm actually more, you know, I tend to look at a macro level and I kind of boil down to a micro level, but overall I'm more bullish in 2014 about certain segments than I was in 2013. I think interest rates have the potential to creep up, and I think that will be offset by sort of economic growth. I mean, if you look at the last GDP report, was actually pretty positive. I think it's like 3 and change %, which is really great. It actually, the first time it hit its goal in a while. the Fed tapering should be a good sign, you know, so when the Fed announced, like last year you mentioned that the market kind of took a hiccup, I guess it was late summer, early fall, when the Fed started to hint that they were going to start tapering. It should be the opposite. It's, you know, tapering is our medicine, right? And if we don't need it anymore, we're no longer sick and we're getting healthier. So finally the stock market responded the right way during the last announcement about tapering, and it actually went up when they said things are getting better. So I see that as a positive sign. I feel like overall the momentum is moving in the right direction. So I tend to think that we're going to see a pretty good 2014. I don't know if we're going to see huge price jumps, because I think a lot of the positive momentum that's going to be happening in the economy in general that will trickle down into New York City will be offset by expanding interest rates and expanding potentially cap rates. However, I just overall, from an investment standpoint, I feel like it's a better climate to be playing in. Now that being said, the residential market still makes me a little bit nervous, because I just don't see prices going from 2,300 foot to 2,500 foot to 2,800 foot and keep escalating. I feel like we're at a very high point already. Generally, I feel very bullish.
Yeah, I would agree with that. I mean, I think we're going to start to see, we touched on this a little bit earlier, but in these markets that are more emerging neighborhoods, you'll start to see outsized rent growth versus the Manhattan core. And, you know, if you're a value-oriented investor and seeking out those opportunities in Brooklyn and Upper Manhattan, I think you're going to see really strong rent growth in those neighborhoods as people flock to, you know, quote-unquote affordable options. You know, in general, in the land market on the condo side, I don't know that we're ever buyers of land at $900 a foot, but, you know, never say never.
Yeah, I think Justin's right. I think one thing he said is important, which is just strictly on a numerator denominator perspective, that sort of rent growth, you know, $4 in a $40 foot side is very different from an $80 foot side, right? And so therefore, you can actually achieve significant percentage rent growth on those sort of outer borough markets. I think, you know, we're generally the mindset sort of flattening is coming in. I don't really see much significant growth in the valuations, but we're generally optimistic in the city. I think there'll probably be a little bit of a pause connected to the administration change, just in terms of people seeing how things are going to play out, where the priorities are going to be, some of the zoning stuff we talked about. But otherwise, you know, we're still optimistic.
Yeah, I see a coming normalization of the rate of change, but
Nice.
but you know, I'm not optimistic enough to think that land prices are going to go down.
So with that, let's open it up to a few questions before we finalize this morning.
Hi, I'm Conrad Smith from Real Estate Weekly. So Shimon, when you had your presentation at the beginning, can anyone hear me? Alright, so Shimon, you mentioned that the Bronx is an area where yield can still be achieved. Then when you asked the panelists which neighborhoods have the best growth potential, no one mentioned the Bronx. What's wrong with the residential market in the Bronx, and can it ever be as hot as certain neighborhoods in Brooklyn or Queens?
I'll take that. Our Bronx is a very important part of our business, has been, will continue to be. So my apologies to the Bronx for not having mentioned that in terms of markets. It's actually interesting, we've talked about this before. In the Bronx is an incredible amount of resources, incredibly well serviced from a transportation perspective. I think there's sort of sub-markets that are extremely strong. I think as the world is recognizing that there's incredibly interesting, perhaps more interesting life outside of Manhattan for sort of newcomers, the Bronx will continue to thrive. We largely do sort of mixed income stuff in the Bronx, although we're looking actually at more market-based, sort of exactly what you're describing. So I think there's a real possibility there. I think also as the pricing gets a little crazier in some of the other locations, kind of, you know, your traditional, lack of your artist submarket, what was traditionally your Williamsburg, whatever you want to call it, folks sort of looking at various submarkets in the Bronx and thinking this is a nice place, but also just the core workforce location, Bronx, sort of nice parks, good transit. Look, transit in schools and parks, that's the essence of economic development, and so I think the Bronx is focused on that, so I'm hopeful. That being said, it's still somewhat of an uphill battle in terms of folks coming to New York and affirmatively saying, oh, I want to, not folks, but sort of the core market that we've been talking about for sort of the new rental market. But we've been very bullish on the Bronx historically, and I think we'll continue to be. And you're right, there are sort of value opportunities there.
And I think you really can see yield there, and I think that the preservation game that we spoke about before is doing really well there, especially if you have buildings that trade hands on a preservation level. They do very well there. So the Bronx has a tremendous opportunity to grow in terms of sales in 2014, as well as value. Just because it's, at the end of the day, you have to compare what you get in the Bronx to what you get in Northern Manhattan, what you get in certain areas in Brooklyn, and the yield is still a lot better. And so that we expect higher pricing in the Bronx, at least from the residential market, the multifamily market in 2014. Other questions? Yes, please.
Hi. So there is a lot of appetite. Oh, thank you. I'm Jackie Teplitsky, and I work with a lot of people, especially from Argentina and Brazil. And because of the political situation over there and the economical situation, there's a lot of money that has to get out of there. And they have been outbid left and right here in New York, trying to get into new development because they have been trying to do it on their own. What would be your advice, because they are basically competing against all of you, about them being able to get into the New York City new development market, and of course to be able to win and buy the land?
Pay more.
I was going to say something self-serving as well. Partner with us.
Partner with them. I think they should do what we all do, which is pick a market that you really want to focus on, decide you want to buy it, lose 5 times, be incredibly annoyed, and the 6th time say, I'm going to overpay, and then you'll get it.
Ronald Gold, real estate appraiser with the New York State Supreme Court and U.S. Tax Court. I'm interested about, and you talk about land value versus M-zone property versus R-zone property. In 2013, what would you say would be the difference in buildable square foot FAR between M-zone and R-zone, with the expectation of the M-zone possibly transferring or being upgraded to R within the next 2 or 3 years?
Several $100s a foot?
Yeah, I mean, it's a great question. I'll tell you, I think too many land sellers in an M entitlement play insufficiently discount the price based on the challenges of rezoning, particularly now. I would say, we find, I don't know about you guys, increasingly that sort of, the vig between the rezone is just not that much, and people are like, well, it's not that much risk there. And the truth is, in some markets there may not be much risk, in others there's a substantial risk. So it's incredibly site-specific. It's incredibly specific to what city planning has been thinking about for that particular M zone. If I'm kind of an island of M in an area of residential without a specific industrial policy connected to that, that's a fairly easy underwriting, right? If I'm in an M zone in a C of M and there's a policy to sort of help support, tech and industrial stuff, they should be, as Kevin says, a several $100 a foot differential.
My name is Ezra Monsevi, and I'm an urban planning student with an ION development. I wanted to get an opinion on Yonkers. I know that it's an extension of that Broadway retail corridor. You've got great subway access and Metro North, views of the river, and a lot of development in downtown. Maybe this is a question for Mr. Dishy, but goes out to you.
I feel like I'm a broken record. We actually have 5 projects in Yonkers. We're incredibly bullish on Yonkers. Although I would say, the Yonkers has had an era of, sort of like the monorail. It's the perpetual technology of tomorrow, the perpetual next market of tomorrow. But I think Yonkers' time has definitely come. As you said, you described it perfectly. If I were you, kind of starting out in development, I think Yonkers is an incredibly good place to focus.
Thank you.
Any other questions? Yes, please.
Going back to affordable housing, I know the mayor is considering, in order to discourage land banking, he's going to raise the taxes on land with the idea of, encouraging developers to build. But some developers will just build a single family, single level warehouse. So it's not gonna, the result is not gonna be what the mayor's looking for. I mean, what do you think about that specific program? And if you're advising the mayor, I mean, what do you think is best with affordable housing? Is it just a 421A type program or something similar?
The fact is there isn't much land. Most development sites already have something on them, paying taxes. I think that's more of a talking point than anything else. From my point of view, the development world doesn't need enough sticks. We could use more carrots. I think there's real opportunities for city planning and HPD and various agencies to work together to generate affordable housing opportunities without much capital subsidy, mostly by rezoning. 421A or a similar program, probably a new program that doesn't have the connotations, could do a lot. Tax reform for multifamily tax on an unsubsidized, exempt project is 25 to 30% of your gross income, which is pretty hard to underwrite. Reform of unsubsidized real estate taxes, new programs that encourage affordable housing, inclusionary bonuses that are more of an incentive than the current programs. Just scaling up the existing programs could help the mayor achieve his goals.
One last question. Okay. I want to thank the panelists here for being here today and showing their wisdom. Thank everybody who came. Please feel free to stay, to eat, to network. Thank you. Thanks, Shimon.